Stenemo, welcome back to the show.
Thank you.
How are you doing today?
Wonderful as usual.
So today we are still digging in this deep rabbit hole of financial independence, but I can assure you that there will still be a light tunnel if it wasn't already. But I think that one thing that we need to discuss more thoroughly when it comes to financial independence is more the tactics. And when I refer to tactics, I specifically mean the stock market. And the stock market is, you probably heard before from both of us, a weighing machine if you play the long game. But other than that, do you have any comments on like stock market in general and how one should go about it, just to start off the conversation?
I think it's easy to get distracted by some details that are not as important. So when it comes to stock market, there are many different ways of looking at it, and it really depends on where in your financial situation you are and what kind of part of the stock market you're interested in.
Okay, so could you say that you could either look at it as some kind of trader or speculator or more as a value investor? Is that what you mean by different ways?
Yes, that's one way of looking at what kind of risk and what kind of certainty in the future you have.
Okay, so let's tackle stock market from a financial independence perspective. And if I can make a pretty educated guess, I guess that you want to have the most long-term view as possible when it comes to the third bucket, and probably a little bit for the second bucket as well. And you can watch the previous episode if you are unfamiliar with the term second bucket and third bucket, because that's a framework that we use. So could you walk us through, like, for people who haven't invested yet, how they should go about it to make sure that they are hitting their financial independence goals whenever they want? Because there could be like funds, index funds, like stocks, there could be other kinds of investments that are worth pursuing it. But as you mentioned in the beginning, you shouldn't really get too bogged down in the details. So if you could get this valuable 20% of information that will cost more than 80% of the result, it'd be nice for our viewers to listen.
Yes. So in short, when it comes to financial independence, what you want is a very stable return for the rest of your life. So that basically means that you don't want one single company to have a big influence on your financial situation. So you should be fine with having just index funds that don't produce impressive results. You would much rather have 1,000 mediocre stocks that you know that they're going to keep giving dividend for the rest of your life, rather than having one great company in a great trajectory, but with a high risk of failing in the next 20 years.
Okay, so that's a pretty good way to tell that index funds are the way to go, since they kind of represent the average of the entire market, so to speak. Are they, because I can imagine there are many index funds as well, are there particular criteria that one should have in mind to evaluate which index fund are the best one to regularly pour money into?
So I think for most people, they are planning to live in the same country that they are currently making their income in. And in that case, it makes a lot of sense to have more money in your local stock market than in a global index fund. That being said, if you are not planning to live in the same country and thereby not having the same currency in the future, you might actually want to invest in that country where you're planning to retire in, due to the risk of inflation in one of the currencies, and also the hassle of having to change between different investments, potentially having quite a lot of extra costs added to them when you take out the money to live off.
Okay, but what if you're not really sure where you're going to retire? Could you still operate from the local market where you're currently at right now, so you don't maybe have to?
Yes. So I would say that the more uncertain you are about your future financial situation, the more pessimistic you should be of how much money your portfolio will generate. So as we mentioned before, 4% is what you should be able to live off. And that assumes that your portfolio actually generate quite a lot more than that, but also that inflation stays around 2% for the rest of your life. And as most people who've lived for 40 years plus are well aware, there are years when the inflation is 5 times as high as that. And it can also be in the opposite direction. And there are also situations where the currency that you are currently making your income in loses half its value in a matter of week or month. So for many reasons, there are several good ways to diversify your portfolio so that the one currency where you make your money shouldn't be as important once you hit your financial independence. One way of doing this would, of course, be to have your money in different currencies, or something that is supposed to be inflation safe, such as gold, for example, is a classic investment that is supposed to be immune to inflation. But that is not really the case, since also gold has a supply and demand and a fluctuation over time. time.
Okay, and I want to come back to how you balance gold and index fund, but if we just linger around index funds a little bit, would you say that it's better to have one particular that is of the local market to invest upon, or should you have maybe 3 or 6 or 10 different index funds just to diversify even more? Because, and the reason why I'm asking is because like index funds are quite diversified already. They represent like the top skim of the market, so to speak. And I understand that you want to diversify in order to mitigate risk, which especially when doing the long-term one would be quite beneficial. But would you opt for quality but few index funds, or quantity but a little bit more scattered index fund, if you want to continue that route?
So it really depends on which specific index fund we're talking about. So now we're already getting bogged down with the details. So there are some index funds that are very broad. So when you say a global index fund for the entire world, then we're talking more than 2,000 companies. And even then, the biggest 5 companies will actually be more than 1% each, usually, because the biggest companies in the world are so much bigger than the smallest ones, or even the median stock company. But when you talk about other index funds that are local, let's say that you're talking about a Swedish index fund, the most popular one is actually only 30 companies, because that's how the Dow Jones also started out, being just 30 companies. And the only reason that it had so few is because way back when it was created, it was already then that the biggest 30 companies were most of the stock market, but it was so hard to include all the small ones. So it was easier to just ignore the small ones and just focus on these bigger ones that were still making up most of the entire stock market. But today, when we talk about a index fund, it doesn't really make sense to focus on these popular ones like Dow Jones, because it's only 30 companies. And those companies actually tend to perform worse. So the larger a company is, the more stable its income is. And then it's not as likely to grow its income as a small company does. So for most people who are willing to take a higher risk, most people would recommend a smaller index fund, an index that focus on smaller companies rather than an index fund that focus only on large companies.
Okay, but we are still referring to index fund as kind of singular. So that means like, okay, now I have to, or not really have to, but it's best to either choose one that has 30 companies, let's say, or one that which has like 2,000 companies per se. It's not like you have to somewhat get a lot of different index funds and reinvest in them accordingly. So there is no single rule of thumb in terms of how many different index funds are advisable to have.
Correct. Since there are such a broad spectrum of index funds, you cannot really say that you should have 5 specific ones. You could say that you want to have quite a lot of small stock in your index fund, meaning that you could have several index funds that are, for example, a local small stock index fund for the currency that you make money in, and a global small stock index fund. But as we said before, if you do not know where you want to live in the future, you might want to have less in your local index fund. And if you think that you want to have if you're closer to your financial independence and you want to quickly start using your financial independence and have a stable income, you also want to have less of these small stock index funds. So there are many different factors that determine what kind of risk you're willing to take, even in your third bucket.
Okay, that's a pretty good answer. I think it covered a lot of the confusion I had earlier. So let's...
Another thing that's important to mention here is that it's also quite important to look at what specific companies are included in the stock index fund. So if you have 5 index funds that have a lot of overlap, it doesn't really make sense to have all of them. And it's quite common that you can only find 1 or even as few as 2 index funds that are quite inexpensive. And when it comes to index funds, it's even more important than when the rest of the fund market to focus on the specific costs with owning it. So the fees of owning the index fund should be your guide. So for most people, taking the cheapest small stock index fund would be better than taking the one that has the highest return in history, because those usually end up having similar performance in the future.
So you mentioned fee, and I kind of assume that they are not the courtage fee that often associated with buying stocks. Is the fee like deducted from the more annual result, or is it more direct in terms of a withdrawal from the immediate bank account? How should one go about the fee?
For most people, when they look at a stock to buy, there's a fee of buying it and selling it, which is the same. But for most index funds, when you buy it, you do not pay a fee for buying it or selling it, but you pay a fee for for everyone else who buys and sells it. So in the end, if 100 people buys an index fund and then sells it again, someone has to pay this cost. And you essentially end up doing that every time you buy and sell it. But you also end up paying that for every year you own it, because during the year that you own it, other people are buying and selling it. And that cost is then covered by the index fund. And that then added as a fee, a yearly fee that you end up paying every day. So you cannot buy an index fund and then sell it the next day to make a profit. You end up paying this cost even though you do not see it when you buy it or sell it.
Okay, that's good to know. So let's take it to its most concrete form, because normally it's like via kind of a bank that you get the index funds in the first place. Do you have any recommendations? Like I know that Avanza is quite popular in Sweden, but are there other kinds of banks that could be? And of course, it might vary from country to country. So I'm talking more in general terms. Which banks would be the more favorable for financial independence people? Like, would the fees be a good comparison to see, like, okay, I want to use this bank over another bank, or what denominators could there be to select which one to do the transaction?
As with many things in the last 20 years, it's actually been quite clear that the small individuals can vote with their money. So depending on where you are in the world, by choosing to go with the cheapest option that still has good safety, so some high quality bank or investment portfolio is a much better option than a big bank that has large fees, both because you end up having a better deal, but also because other people will end up having a better deal in the future, including you, by voting with your feet and move your money where you get the best deal. So I would strongly recommend most people to look for the best option and then see if this option is of high enough quality so that you are okay with it. I know for Sweden, Avanza and several options that are similar, where you have a good price and the government has a good way of controlling the companies so that they cannot take your money. It's actually quite well regulated in most countries today. So even though you buy it via a specific bank, the bank cannot move the money because they never actually take your money. They only send it via several banks in order for you to have the ownership. So you can be quite safe in owning stocks and index funds via any large government sanctioned bank in most Western countries. And same in the States, where you have, for example, Robinhood, that for the most part, if you deal with index funds, you can be quite confident that the cheap government sanctioned banks will be safe enough for most people. Of course, that will vary in time, but today it's been very few cases of that being a problem.
Okay, that was a great answer according to me. So once we've got our index fund or index funds and set up some kind of recurring payment, I earn this much and therefore I can make sure that, because of the first things first principle, to make sure that the savings go there automatically via some kind of a collaboration between one's own bank and the index fund itself. Once you establish that automatic procedure, can you basically forget the index fund altogether, or do you have to do some kind of rebalancing, so to speak, on a maybe annual or twice annual basis? Is there more maintenance than just having a workflow?
For most people, you can be fine with just having a yearly recap of your financial situation. Although for most people, this is not something they actually end up wanting to do. I would say that the fewer times you check your portfolio is usually best, unless you're very interested in your fourth bucket where you do your speculative investment. But when it comes to index fund, it's enough to just set it and forget it, so that you take your salary that you get each month and you automatically invest it in whatever index funds you have decided at the start of your year, for example. And then at the end of the year, some index funds will go up more than others. And then you can decide to either keep investing the same amount year after year, or you can decide to rebalance it. For most people, it doesn't make that much difference if you rebalance once a year, twice a year, or even every few years, because there's a lot of fluctuation which index fund will perform best from year to year.
Okay, when we say rebalance, do you mean like if you have, for instance, 6 different index funds that are different in terms of size, that you want to level them out? Is that what rebalance means, or have I misunderstood the term?
Yes. So for most people, you could say that they might want to have 10% in their biggest index index fund, and then maybe 9% in their second biggest index fund. And let's say that after 1 year, this has changed so that the one that was the biggest has now decreased to, let's say, 7%, while the one that you had 9% in may have doubled in an extreme case. So that one has closer to 20%. And then you could decide that you want to sell the one that has gone the best to buy more in those that have not done as well. And for most people, this is fine to do. And from year to year, it will fluctuate a bit. But when it comes to index funds, it will usually not fluctuate that much in a 5-year period.
Okay, so you want, for instance, like the largest index fund to have a certain percentage, second to have a little bit below than that, and so on and so forth. And by doing this rebalancing, it can still maintain that kind of standard.
Correct.
Okay, nice. One thing I want to ask before we move on to various different allocations, including the gold. Okay, nice. So let's go over to different kinds of portfolios, one might call it, and that can probably relate to fourth bucket as well. One term that I've heard you mentioned when I mentioned stuff like Barbell, which I want to discuss as well, is a thing called Dragon portfolio. And seeing as you mentioned gold before, could you take the time to explain for us how the Dragon portfolio looks like, and if that's something that either for beginners or too advanced, or what's up with the Dragon?
So the Dragon portfolio is something that if you take a 30-second summary, it's quite simple. And if you spend 10 hours learning the details of it, it's very complex. So in the 30-second, just the overview of the Dragon portfolio, what the goal is that you want to make sure that you don't lose money any year. So every year you should have something that makes profit, even if all other things loses value. So you want something that is independent of the stock. And depending on what happens on the stock market that causes it to decrease in 1 year, you could have other things that goes up. So one famous example of this is gold. Usually gold doesn't fluctuate as much in 1 year as the stock market. And usually they do not go down simultaneously, although that also happens. So it wouldn't be enough to just have 50-50 gold stock market. So what the Dragon portfolio tries to do is something more advanced. It tries to also have other investments that are independent of each other. So for most people, the simplest way of thinking about this is that you could have your apartment, your house, where you have, for example, a tenant. That income will come no matter what happens to the stock market or what happens to gold. And you could also own a piece of land, and that land could increase in value regardless of what happens to the gold in your vault. And you could also own a forest on this land. You could own other things value that could increase in value, like a painting. So there are many things in the Dragon portfolio that complement each other, so that even if everything goes bad on the stock market and you lose your tenant, then your painting might still have increased in value.
Yeah, let's hope that the tenant might not be lost. But all right. So could you say that there are maybe 5 different categories? One could be gold, one could be index fund, etc., that one should keep track of, to get this kind of balanced risk mitigating portfolio that is the Dragon?
So for most people, I think it's fine to think of it as 5 different things. And I think that the most popular ways of doing this is essentially 5 different things. And another thing that is common among these 5 is to just loan out money. For example, putting your money in a bank with a proper interest rate, which is hard to find these days. So then you might want to lend out money to the government, where you get slightly higher return on investment, higher interest rate. Or you could even loan money to a company that have a higher interest rate. But then you also risk losing that money. And this is why you have a higher interest rate when you lend money to a company. So there are many different 5 things to put into this. And it really depends on how much time are you willing to invest into making this Dragon portfolio. So what happens today is that very few people actually end up having a proper Dragon portfolio. Most people end up having a Dragon portfolio inspired portfolio, another vehicle that is basically a hedge where if the stock market goes poorly in one specific day, those investments will actually make a profit. So it's considered an insurance against the stock market. And that's actually the big selling point of the Dragon portfolio, that it has this specific investment that is supposed to be anti-correlate. So it's supposed to go up when the stock market goes down and vice versa. But this specific part of the Dragon portfolio is not actually easily accessible for any individual investor. It's basically only possible to buy for an institution. Let's say an organization that has $1 billion. Those would be able to buy this specific investment vehicle. So you and I cannot create the ideal Dragon portfolio as it is usually described.
Okay, that's a good way to put it. And if you could compare it to the Barbell one, which I suppose would be to have a large percentage in the most risk-free assets as possible, and then have a very speculative side to gain advantage of positive black swans. How does it compare to the Dragon portfolio, in your opinion?
So with a Dragon portfolio, your goal is not to make a lot of money. It's supposed to be safe to have it invested, and it's supposed to generate a decent return on investment, assuming that the world continue to improve as much as it has in the last 100 years. When it comes to the barbell strategy, essentially, when it comes to investing a lot of money in the stock market, you're willing to risk having a bad year and even a bad decade where you lose a lot of money and you're behind after 10 years. But you're also expected to make around 8% per year inflation before inflation.
Okay, so I guess it all comes down to the various objectives and how playful you want to be with the circumstances.
Yes, and I think it also depends on how you look at it. So from some investors' perspective, let's say, for example, Warren Buffett is famous for this. He's been financially independent since he was 30 years old, essentially. But rather than then move all his money into a safe investment, he wanted to keep his money invested in high-risk investments where he could then generate more money so that he could donate the money in his last will and testament. So by taking a high risk, he does not personally stand to gain that much, but he's able to donate a lot more money to charity. And that, I think, is what most people should do. Even when they have reached financial independence, I do not think that they should move to a Dragon portfolio, try to not lose money situation. They should rather try to keep the money invested in reasonable investments, for example, index funds, and then aim to donate more money to charity at their last will and testament.
Okay, that's something we could touch upon maybe next or the episode after that. But to kind of conclude this stock market segment in this mini series of financial independence, I want to mention a term called dollar cost averaging. If you're regularly pouring in a certain amount of money into index funds, would you say that you're doing dollar cost averaging automatically, or is there more manual procedures to be done?
For most people, the setting and forgetting of just every month when you get your salary, the first thing that automatically happens is that a certain amount is taken from your account to your investment portfolio and automatically invested in whatever you have previously decided to invest in. That is essentially all you need to do in order to gain dollar cost averaging, because then if the stock market goes down by 20% early in your investment career, when you do not have that much money in the bank, then it's actually a good thing, because then you end up buying more those months when the stock market is lower, and then you do not feel the need of having to sell money because you know that you're supposed to every month invest. So this prevents you both from selling when things have gone down, which is usually the worst thing to do, and it also prevents you from buying extra when the stock market is at its highest, when everyone is optimistic about the future, which is usually the worst time to invest.
Yeah, so it's like what Warren Buffett said, that you should be greedy when others are fearful, and the opposite, be fearful when the others are greedy. And I think in general, that's a good way to go about it, to rather be, instead of being blinded by all this volatility and fluctuation, to know why you're being there in the first place in order to get the patient reward, so to speak. Any last words about like stock market and everything we talked about so far before we close?
Nope.
Nice. So with that, I want to once again thank you for partaking in enlightening conversation.
Thank you.